Have you ever wondered why most new traders are actually not profitable and losing money in the markets? Well, what if I were to submit to you that the reason as to why they're not profitable is not because the markets is unpredictable, but it's actually because you're making the 5 mistakes that most traders actually make that is actually hindering them from actually becoming profitable. So today in this video, I'm actually going to reveal to you what they are so that you can actually finally become a profitable trader yourself. Now, before I actually get into what buying high, buying low, whatever those cases may be, those are the issues that most traders are actually making. But I want to actually give you the understanding of why it's important for that to become clear for you before you become a profitable trader. So mistake number one that most traders actually make is they don't have an actual plan, right? Now, the reasons as to why that is an issue is because they're guessing, and what I like to say best is a guess creates unnecessary stress, right? And so when we're looking at the market and we're just basically taking trades just simply because the market is moving without actually being able to understand what buy even means or what sell even means, then now, again, you're creating unnecessary stress for yourself because you are now putting yourself in a financial bind that you can actually now lose money and not even actually know why. So for starters, let's actually identify what it actually means when you're actually buying. What are you actually identifying in the market or telling the market that what am I actually buying or what it is that I'm actually selling? So buying in its essence is when you're expecting the price or where the price is currently, you're expecting that price to move up from where you originally, suspected it was going to move, right? And then vice versa. If the price is currently here, right, and you say, oh, I'm expecting a sell, you're essentially saying that I'm expecting from that original area, I'm expecting price to fall from my original entry, right? And so what we have to be able to identify, there's actually 3 checks that allows us to make sure that we don't just continue to keep being like most traders where we're just buying and selling without really actually knowing where we're actually buying or selling from, right? And so the first check that we actually want to identify simply is just to identify, is the market overall bullish or bearish? Simply just meaning, is the market actually moving in an upward direction or is it actually moving more into a downward direction? The reason why that's so important is because the trend is your friend. What that means is you don't want to be putting yourself in a position, if you understand that the market is telling you that you are supposed to be buying at a lower position because you're expecting it to rise, you don't want to now be buying at a higher position knowing that sellers are more in this area than anything else. And so when we talk about this buying low and selling high, it's simply because it is obvious for most traders to identify areas where there is what we call a support, allowing price to not fall beyond that area. Now, what happens when that price cannot fall beyond that area, it actually allows it to act as a floor, which essentially is allowing price to start actually continue up. If it cannot break below that zone, it only has one option but to just go up. So what we're doing is we're looking for those key levels that actually has shown us in the past what price was willing to do in the past to then identify those zones and then to actually make our predictions, right? And so again, that allows us to being able to know where these common areas are so that now we actually are not just buying at a sell high scenario and then vice versa, right? Which actually leads me into my next point, right? Most people don't know what buying low or selling high actually means. But all we're doing is we're taking, like I said, information from the past and being able to understand that what happened in the past is a good chance that we can actually be able to identify those zones in the future, right? And the reason why that is so important is because when you're able to understand the simple support and resistance acting as a floor, the floor is actually supporting you, keeping you up. And so what we're basically saying is that if price is being supported below, then now that leaves a good chance for it to actually continue to keep going up. But vice versa, if price starts to actually stall at a certain area and can no longer break above, then it's actually acting as a ceiling for price to actually not be able to move any further past that zone until it actually gets enough strength to actually break out from that, right? So the third point, that most people are actually losing out a lot of money just simply because of this one mistake, is simply they're not trading with a stop loss, right? So a stop loss is actually something that is very similar to a seatbelt, right? When you're getting on the road, one of the first things that you do before even, I would hope, but even before starting your car, is making sure that you're actually putting a protection guide on your actual self before actually something, actually happens later on, right? What good is the seatbelt itself if eventually you're driving and it might not even be your fault, but if somebody else is now driving and you wind up intersecting with that person, but you didn't put no protection in place, what now happens to you, right? So what we're doing is that stop loss, when you're getting into an entry, before you even get into an entry, the first thing you're doing is you're buckling up. You're protecting your account, right? That which essentially is allowing you that if you are wrong on that trade, right, which is going to happen at some point, but this actually allows you to already be protected and to already know how much you're actually willing to risk per trade, right? And so it's your protection. It's what you actually want to make sure that you can't lose any more money than that current level of what you actually set it to, right? And so again, it's putting up certain barriers that most people, the reason as to why they don't actually use a stop loss at all is simply because they are afraid to actually lose in general. And so one of the things about trading with fear is it actually forces you to not think correctly and using actual, proper decision making into every trade that you take, right? And so what we want to do is understand why we're getting into the trade before we even start in the first place. Again, if we have the entry that we already are expecting to, take that setup, what we're wanting to do now is to identify an area where we do not want to be in that trade no longer because it's actually going outside of our trading plan. Make sense? So with that being the case, like I said, we're always going to buckle up before we drive. Same thing with trading. We're always going to identify what it is that we're comfortable willing to risk first. And then once when we have identified what we're willing to risk, we're definitely now going to take in even more consideration of what is it that we're willing to win if we do win. And so that comes into play is what you want to do is anything that you're willing to risk. Let's say if you're willing to risk $50, right? What you want to do is at least want to make more double than the amount of what you're willing to lose. So now this puts you in a position to where any time that you actually make another trade, you can now, which is called a 2-to-1 ratio, you're willing to make double the amount that you're willing to lose. It allows you to being able to have a 40% win rate and it's still being a profitable trader. So we're good on that? Mm-hmm. Excellent. So now the next point that most traders are making this common mistake is they're risking too much. So if we have $1,000 account, right, we're wanting to simply trade 1 to 2% of that actual account. So 1% of $1,000 account actually is $10, right? So if you're trading 1 to 2%, that's 10 to 20 something dollars, which is allowing you to actually become more suitable in protecting your account from certain decision making like this, right? And so what we have to be able to identify is that if we're willing to make 1 to 2% per trade, this also allows us to start protecting our account while also allowing it to grow, because see, now every dollar that we make, we can also contribute that back into our account too as well. Okay. And so again, the key to this is protecting your account more than anything. So we're not talking about risking $200 and $300 because that's now 10 to 20 something percent of your actual account. And so that's too much that we're willing to risk for that individual. Okay. And then the final point as to why most traders are not profitable is simply because they're wanting to take every single opportunity that they see simultaneously while also trading multiple different pairs. Specifically, I trade gold. And so the idea behind that is every single pair or commodity that you choose to trade, they have actually what I like to call different personality types, right? And so with that being said, not every chart moves the same way. And so if you are creating a trading plan specifically for gold, but then you try to use that same strategy for Euro USD, right? It's going to put you in a situation of you not actually being able to really know how that strategy actually plays out for you in the future, because you didn't test that in the actual Euro USD, right? And so what the reference that I like to describe this is, what person are you going to be more afraid of? Are you going to be afraid of the person that knows 10,000 different moves, right? Or are you going to be afraid of the person that actually knows one move and has practiced that 10,000 times, right? So the idea behind that is the person that has practiced one move and become significantly better at that one move is the actual person that's going to be actually more effective at being able to execute that one move versus 10,000 different ways of, you know, so-called trading, but it actually allows you to not actually be profitable because you're trying to take every single opportunity in the market and you're not actually mastering any of them, right? And so again, these are the common mistakes that most traders are actually using in the markets, and if you change these, this would actually allow you to become a profitable trader. So hopefully this helps you in any kind of way, but stay blessed.